Hello, my name is Peter Hicks, a research analyst at Chelsea Financial Services, and today I'm here with Tim Levett, non-executive director at MVM Private Equity, who is now working full-time with Mercia. So Tim, perhaps you could give us an overview of MVM and the recent deal with Mercia and how that's going to work.
Certainly. Mercia took over the management of the Northern VCTs from MVM at the end of December. The rationale for this is that Mercia are 100% focused on venture investment, whereas MVM are partly focused on MBOs, which are no longer part of the VCT mandate, as well as early stage deals, and they have a very strong regional presence. The combination of MVM's VCTs, the Northern VCTs, and Mercia make Mercia a leading regional venture capital investor. They have 8 offices, they've got 60 investment executives since they've done this deal. And what will this provide for the shareholders is a number of things. One is it'll increase the deal flow. They have a huge deal flow. Admittedly, some of these deals are far too small for us to consider combined with ours. They have the regional presence, which enables us to both benefit from their presence and our track record. They also have something which is really important for the VCT shareholders, which is flexible funding. At the moment, VCTs are precluded from doing any form of replacement capital or acquisition finance. And that is going to be a big issue for all VCT portfolios. As companies grow, there needs to be management change. Consolidation needs to take place between investee companies, and they have non-state aid funds which we can draw on to co-invest with the VCTs.
And what makes MVM different from other fund managers, and why should investors choose MVM?
MVM, first of all, has pretty much the longest track record in the market. The first funds were raised in 1995, a very loyal base of shareholders who stuck with us. We have evolved over time from being initially a very early stage investor, which is what Ken Clark envisaged when the rules came out, to being a mixed investor in the 1990s, both MBOs and early stage, to being predominantly MBO investors between about 2005, 2015, and now we're focused on early stage investment again as a result of the rule change. And what investors will get in MVM is that 85 million of the value of the portfolio is held in mature MBO investments, which we expect will provide some yield over the next 2 or 3 years, and 100 million is invested in the early stage portfolio in 30 companies, which are growing and over time will provide both capital growth and dividend opportunities.
And I'm right in saying that the people that worked on those MBO deals in the original portfolio are still working with those companies. Correct. Up until the point.
Very good question. So there are 2 things going on which makes this very much business as usual, or 3 actually. Firstly, the whole of the venture team have transferred across to Mercia and are being run as an autonomous independent division within Mercia, with their fulfilling the investment strategy of the VCT boards. Secondly, there's a transitional service agreement whereby all of the administration of the fund, shareholder relations, financial reporting, fund administration are still being handled by MVM pretty much to the end of 2021. And then finally, all of the MBO assets are remaining with MVM on a subcontract basis until time of exit. So that portfolio of around 20 investments will be managed by the same partners who did the deals in the first place.
And with the new style investments you've been doing, the growth deals you've been doing recently under the rule changes, if you could perhaps discuss some of those deals with the companies.
Yes, certainly. First of all, overall, the shape of the portfolio, around 60% of what we've invested in is tech related, most of that being software. The other 40% is split very broadly, a small amount of money in life science investments, quite a lot in service companies, a bit in leisure. And the whole plan when we set out was to have a diversified portfolio so that there may be some companies at the top end, we certainly hope so, which could sell for over 8 times money But there's also a balancing group of companies which are lower risk. That's a relative term at this end of the market, where we'd hope to get 2 to 3 times our money.
And being that Northern is based in Newcastle, you do benefit from not being so London-centric with what you get.
Indeed. So we have increasing amount of resources outside London. We have 3 investment executives in London. The reason for that is that's where the talent pool is. They are not only doing deals in London, then we have executives in Birmingham, Manchester, Newcastle and Reading. And what we have agreed between the funds and Mercia is that we're making 3 new recruitments in the first half of 2020, which will bring the complement of direct investors up to 13.
Okay, and sort of back to the most recent pipeline that you've been doing.
Some recent deals we've done. The most recent deals we've done are a business called VoxPopMe. Yeah. VoxPopMe is a marketing software company based in the Midlands and with a very big commercial presence in the USA. That is a joint deal with Mercia. That deal was originally initiated, discussions on that, before Mercia approached us. The next one is a company called Tutorful, which is Sheffield based. It's both an offline and online tutor service business, started by a guy who came out of Bailey Gifford, really has grown very well on a very small amount of capital. He's brought revenue up to 3 million, and we've put money in both to enhance his offline activity and create an online platform as well.
So perhaps you could discuss some recent exits.
Certainly. So last year we sold 3 businesses. So a business called MSQ, which is a marketing agency group, to LDC. We're in that investment for 4 years, made 2.5 times our money. We sold Love Energy, which is a business-to-business energy switching company, also to LDC, in there for slightly less time, just under 4 years, for 3.7 times our money. And then finally we sold Closer Still for the 3rd time. Originally investing in Closer Still, which is an exhibitions business, 2008. We sold it to Phoenix Private Equity, rolled over in the equity. They sold it to Inflection, we rolled over in the equity. They sold it to Providence, which is a US VC. On that, over the whole period, we made 7.8 times our money.
Okay, well, thank you very much for coming in today to talk to us, Tim. It was very informative. For further information on the Northern VCT, please do visit the Chelsea FS website and our VCT page for further information on the offer.